50 some slides today, so probably better to get through them. And if we don't have time, I'm happy to answer them, after we're done here with the presentation, and get an email to that individual.
That is great. Thank you for doing that. So let's kick you off. And if anybody wants to still write the question in the chat, and we can address that at the end. Maybe one thing that we can do is if someone else has the same question that you see written on the chat, you can just vote for that question. So we know how many people are interested in that question being answered, and that question will go up into the priority list. So that's maybe one way we can address some of the questions, which I'm assuming several of you might have the same questions. So I will mute myself. I will monitor the chat, and let's get this going.
Well, thank you. I am Mike Bedronczyk. I do work for the IRS, and I work out of the Chicago office. And today we are going to be talking about Schedule C, which is profit or loss from a business, part of the Form 1040 set of forms that a sole proprietor or even a LLC, a single member LLC, can file with the IRS to identify the results of the operation of their business. So we'll be talking almost exclusively about Schedule C and those individuals that file a Schedule C today. So this is focused on small business owners. So today's presentation, we're going to talk about something called, up at the beginning of the presentation, something called the Qualified Business Income Deduction. This came about in 2017 when, under the tax law changes that went into effect that year, corporations got a tax break in that their tax rate was cut. So for business owners that are what we call flow-through entities, like a sole proprietorship or a S corporation, partnership, to try to give those business owners a break, this qualified business income deduction was put into place, and we're going to talk about that. We'll do an overview of the Form 1040 Schedule C. We'll look at how that on that schedule, gross profit and gross income is calculated. We'll also talk about expenses that are deductible on a Schedule C. We'll look at the calculation of the net profit or loss on the Schedule C, and cover other areas of interest to you as a small business owner on the Form 1040. Again, that Form 1040 is what I think we all know as individual taxpayers. It's the individual income tax return, but Schedule C is part of the Form 1040. We'll also discuss self-employment tax and estimated tax. One thing to remember, if you have been an employee, employers withhold from your pay federal income tax, Medicare tax, Social Security tax, and pay that over to the government. But if you are running your own business, say as a Schedule C owner, you have to make those payments of the taxes that you earn on your Schedule C operation. So you've got to make those payments, and you do that through what we call the estimated tax. That's making those payments on a quarterly basis. So we'll look at all that today. So let's start with this qualified business income deduction. And again, it was put in place to try to help small business owners that are organized as what we call a flow-through entity. A sole proprietorship is one such flow-through entity. An S corporation, if you're an S corporation shareholder, you the S corporation is a flow-through entity, meaning that the results of the operation from the S corp and the sole proprietor flow to you as an individual taxpayer. So you're not getting taxed at the corporate level, you're getting taxed on this income from the operation of your business at an individual level. So this was put in place for those types of taxpayers. And as you can see there in the slide, eligible owners of these types of businesses, sole proprietorships, partnerships, S corporations, trusts, and estates, you may be able to deduct up to 20% of what is called qualified business income. If you own qualified real estate investment trust shares, or you also are qualifying for that qualified business income deduction. Also, if you own a qualified publicly traded partnership, you qualify as well. So let's talk about it in a little more detail, the qualified business income deduction. Now, as I mentioned, when I say corporations, I'm really talking about a C corporation. The C simply refers to a section of the Internal Revenue Code that identifies these types of corporations. These are corporations that get taxed at the corporate level. And if there's dividend income that the C corporation gives to you as a shareholder of the C corporation, you're getting taxed on those dividends. So there's double taxation. That's what we're talking about when we talk about the C corporation. So the qualified business income is the net amount of the qualified items of income, gain, deduction, and loss from any qualified trade or business. Includable items must be effectively connected with the conduct of a trade or business within the United States. So it's available if you're conducting that trade or business in the US. Qualified business income, business owners must account for any deduction attributable to the trade or business. This includes, but is not limited to, the deductible part of self-employment tax. So I mentioned just a minute ago that you as a Schedule C business owner, you're not having Social Security and Medicare tax and federal income tax withheld from your pay by your employer. You're now the employer, and you are responsible not only for the payment of the federal income tax, Social Security tax, and Medicare tax that's attributable to an employee, but you also have to pay the employer's share of the Medicare and the Social Security tax. And that's what we're talking about here under the deductible part of the self-employment tax. Even though you've got to pay both the employee share and the employer's share, you are able to deduct basically the employer's share as a deduction on your tax return. The same is true for self-employed health insurance. You know, as an employee of the IRS pays a portion of my health insurance bill, the premiums that are paid. So when you're doing that as someone who's self-employed, you also, and of course, I failed to mention that contribution that the IRS is making for my health insurance is not taxable income to me, even though the IRS paid it. But when you have self-employed health insurance and you're paying the full amount of your premium, to make this more equitable to an employee situation, the tax law allows you as a business owner to take a deduction for 1/2 of the health insurance premium that you pay. So those are deductions that can be need to be included in the qualified business income equation, getting you to the qualified business income dollar amount. So that's just a brief overview of the qualified business income deduction. We want to make sure that you're aware that as a sole proprietor or a small business owner that's not incorporated as a C corporation, that you have that deduction available to you. So we're going to go now into the Schedule C, which is a profit or loss from the business. Again, it's part of the Form 1040 or the individual income tax return set of schedules. So if you're a sole proprietor, or even if you are a LLC, a single member LLC, you can use the Schedule C to report the operation results to the IRS of your business. And we're going to start here at the top of Schedule C and just talk about the line items there, how you would fill it out. This is just providing information about the business, the name of the proprietor, and you can see highlighted over there on the right-hand side, at least my right-hand side, this the item B, where you enter a code, which is the NAICS code. So that is identifying the type of business that you have. And those NAICS codes are identified in the instructions for the Schedule C. NAICS stands for North American Industry Classification System. Now, when we complete the Schedule C, some terms that we'll be talking about, gross receipts and returns and allowances. If you have products that you're selling that might be returned, that's what we're referring to there. The cost of the goods sold, if you're actually selling goods, there is a cost associated with those goods, and that's identified in the cost of goods sold. Gross receipts minus the cost of goods sold gets you a gross profit. We want you to be aware that if you barter, if you exchange goods and services for goods and services in your business, that the fair market value of what you received in that bartering transaction is income, and you need to report it. We'll also look at expenses that typical small business owners have, like car and truck expenses, and something called depreciation. Depreciation, a simple example, if you say you bought a vehicle for use in your business, that the tax law allows, some cases you can deduct the full amount of the cost of that car in the year that you buy it, but typically that cost, say it's $20,000, is depreciated. That an expense, a depreciation expense of that total cost is allocated over the number of years of the useful life of the vehicle. And that's all determined by tax law in terms of the number of years that you depreciate the expense. So for example, a cost of $20,000 depreciated over 5 years, you would take a $4,000 deduction on each of those 5-year return in each of the 5 years, if you've still got the vehicle and using it for each of the 5 years. Finally, at the end of the process on the Schedule C, we come to the net profit or loss, which is the net profit or loss from your business, which is what is used in order to determine the tax associated with the operation of the business, the federal income tax. So here is a Schedule C that includes the first part that we looked at, and then Part 1. In Part 1, we're identifying the income, including the gross receipts or sales, which are just as it identifies, the gross receipts that were received during the year. Any sales that were returned by your customers would get you to, and reducing the gross profit gets you to the cost of the goods sold. I'm sorry. Yes. And then get you to the gross profit there on line 5. Excuse me. Returns and allowances, and then you're on line 4, you're calculating a cost of goods sold, which is calculated in another sheet there in the Schedule C to get you to the gross profit. So gross receipts minus returns and allowances minus the cost of goods sold get you to the gross profit. Any other income that you have from the operation of the business would be reported on line 6, and then get you to the gross income from the operation there on line 7. In part 2 of Schedule C, we're identifying the expenses that are associated with your business. You can see the individual line items that are listed there. In line 28, you're totaling up all the expenses, getting you to line 29, a tentative profit or loss. And then on line 30, the tax law allows you, if you qualify, to include expenses for the business use of your home. And that's actually one of the 8 lessons that we have here in the Small Business Tax Workshop. And it is coming up in one of the following weeks here that will go into that in detail. And it again is just one lesson by itself. Line 31 shows the net profit or loss. And those profit or losses are taken over to your Form 1040 Schedule 1, where tax is determined, the income tax on the operation of the business. Here is that schedule I was talking about, cost of goods sold calculation, where you're determining the cost of the goods sold if you are selling goods in your business. As I mentioned, a lot of small business owners have vehicle expenses associated with the operation of their business. So in part 4 of Schedule C, we ask you to identify information about the vehicles that you use in your business. It's very important to keep track of the business miles that are associated with the use of the vehicle. So if you're using the vehicle for both personal and business purposes, of course, we can only deduct expenses associated with the business use of the vehicle. And you can actually use actual expenses associated with the vehicle use that are business related, or IRS also has an opportunity for you to use what we call the standard mileage rate, where you apply that to the business miles that you drive during the year to come up with a vehicle deduction for the use of your vehicle for business purposes. For example, my wife has a real estate agent business, and she uses, I think it's an app from Microsoft that allows her to identify business and personal use miles in her business. And that's what's used in order to determine the number of business miles. And we use the standard mileage rate to make life a little bit simpler. So if you are using the actual expenses, you need to identify those specific costs and have the backup documentation that identifies the cost, such as oil changes, gasoline, but then also the mileage in terms of how much of the actual cost is attributed to business use of the vehicle. I'm showing you here on part 5 of Schedule C, where other expenses other than that list that we saw in the expense section of Schedule C can be identified. So you would identify those other expenses here. Let's talk about gross receipts and returns and allowances. So the first term that you see on the screen is gross receipts, and we're referring to income that you receive from your customers for the sale of products or services. The second term is returns and allowances, and returns and allowances include cash or credit refunds that you make to customers, rebates, or other allowances off the actual sales price. Individuals who don't make or buy products for resale as part of their business don't have returns or allowances to deduct from gross receipts. Just giving you a little clarity there, I hope. Going back to the Schedule C, again, showing you the first part of Schedule C in the income section, gross receipts or sales, returns and allowances. And then you can see on line 4, we're going to talk about cost of goods sold. And the cost of goods sold is the cost to a business to buy or make a product that is sold. It's easy to calculate the cost of goods sold if you sell all of your merchandise during the same year. However, some of your sales will probably be from inventory that you carried over from earlier years, and you'll probably have some inventory left unsold at the end of the year. Again, this is for businesses that actually are selling goods, not services. So to calculate the cost of goods sold, you start with the cost of the inventory on hand at the beginning of the year, add the cost of additional goods purchased or manufactured during the year, and be sure to subtract the cost of any merchandise withdrawn for personal use, such as food that a grocer might use and take home, or gasoline, for example, that a garage owner might give to his relatives. The result is the cost of the items available for sale to your customers during the year. Then you subtract the value of your inventory at the end of the year, and your cost of goods sold is that remainder. That is done in that part 3 of Schedule C that I showed you earlier, and I'm showing you here again. So there are instructions associated with the Schedule C, and if you weren't here yesterday, we also talked about the resources that we have. We understand a lot of small business owners use tax professionals to help make these calculations and fill out your forms and file them with the IRS. And there are resources at irs.gov to help you choose good qualified tax professionals. So gross profit there on line 5 of the Schedule C in part 1 of the Schedule C. That gross profit, you're first subtracting the returns and allowances from your total gross receipts. Then you're subtracting the cost of goods sold that you've calculated from that difference. Then you would add here on line 6, other income. And as I mentioned, if you have bartering income, the fair market value of what you received in terms of a good or service on the date you received it, you've got to include that fair market value. If you've got bartering income, you'd report it there on line 6. That's just an example of other income that you might have. And then the final term here, line 7, gross income. That's simply the sum of the gross profit and the other income. So again, there are instructions for Schedule C if you choose to do this on your own. And we do have resources if you'd like to get help from a tax professional to choose that tax professional wisely. Let's talk a little bit here about bartering. I mentioned it is the exchange of goods or services without exchanging money, and you need to include the fair market value of goods and services as income for both parties. So the person you're exchanging with also on their end, they need to include the fair market value of what they received as income. Excuse me. And that income is taxable in the year the goods or services are received. For more information, we have IRS Publication 525 that talks about taxable and non-taxable income there. There are certain sources of funds that you might receive during the year that the tax law does identify as non-taxable. So that IRS publication will help provide information on those situations. Let's talk now about expenses that must be considered when you're identifying them on the Schedule C that you file with the IRS. Any ordinary necessary business expense of the business can be deducted. So it's got to be an ordinary necessary expense for your business. And we do have an IRS publication that discusses this concept and provides more details than we can here in our hour that we've got. And that's IRS publication 535. So again, expenses must be considered ordinary necessary in your business in order to be deducted. Let's talk a little more detail about expenses on the Schedule C, and we're back here at part 2 of the Schedule C. You can see that list of expenses that are on the form itself. Let's talk in a little more detail about some of them. We'll start with line 9, car and truck expenses. Again, I mentioned earlier a little bit about the business use of vehicles, and you've got to really make sure that the information that's reported on the Schedule C reflects only the business use of the vehicle that you might be using for the business. We do see that individuals with a vehicle will oftentimes use the vehicle for both business and personal use. You've got to make that clear distinction as to how much of the vehicle's use was for business, strictly business purposes during during the year. So you can take a deduction for the full cost of operating, and there I'm talking about the actual expenses. If you use the car for both business and personal uses, again, divide the expenses between the business and personal use based upon the mileage of associated with each. As I mentioned up front, for vehicle use of a vehicle in a business, you can use either the actual business expenses, the actual you buy tires, you buy gasoline, you oil changes. But again, taking that total and then putting a percentage to that is associated with the business use of the vehicle, which is based upon the business mileage. Or to make life a little bit easier, the IRS has what we call the standard mileage rate. I believe it was 67.5 cents, perhaps in the previous year. I don't quote me on that, but you can get that information at irs.gov. And I'm sorry I didn't look it up before today's presentation. But what it is a per mileage rate that you can multiply by the number of business miles you use the vehicle each year to come up with a dollar amount that you can deduct as the business use for the vehicle during the year. So, as I mentioned, actual business expenses associated with the business use of a vehicle, gas, oil, insurance, depreciation. Depreciation, I mentioned up front, the cost of the vehicle, and then taking an expense for the cost of that vehicle over the useful life of the vehicle, which is determined by the tax law. And that's all identified in the publications that we have. Standard mileage rate, you can get that rate on irs.gov and multiply it by your business mileage. You can claim actual expenses for the first year of business use. The standard mileage rate is not available in subsequent years. So if you do that actual expenses in the first year, you've made that decision for the use of the vehicle throughout its life. Under either method, parking fees and tolls are deductible. And as always, Schedule C instructions will provide more information for you. going back to that part 4 where you're identifying information about the business use of your vehicle. Okay. Depreciation, just again, trying to provide a good, useful, basic description of what depreciation is. It is the deduction to recover the cost or other basis of business property. When we say other basis, you say you buy a new vehicle, but then at some point you have to make major repairs to it that add to its useful life. And you would add the cost of those repairs to the overall total cost as you're depreciating those costs over the useful life of the vehicle. That's what a depreciation deduction is. Land, inventory, and property placed in service and retired in the same year are not depreciable. So land is never depreciable. The depreciation deduction starts when the property is first used for business, and it ends when that property is no longer used or the cost associated with that property has been what they call fully recovered, meaning you've got you purchased a vehicle for $20,000. The tax law says you can deduct that $20,000 over 5 years. Fully recovered means you've had the vehicle for that full 5-year period and you've deducted the full $20,000 over that 5-year period. So the cost has been fully recovered. Depreciation, it is kind of involved, and there is IRS publications devoted exclusively to depreciation and depreciation of these larger assets that you're buying for the use in your business. The modified accelerated cost recovery system is the system that is in place under the tax law to depreciate property. And when it says tangible property, we're talking about physical property, like a car. The Section 179 deduction is an opportunity under the tax law to deduct the cost faster. Under the example I've been using for a vehicle, you've been deducting the cost over a 5-year period. But under Sections 179, if you qualify to use a Section 179 deduction, Section 179 simply refers to the Internal Revenue Code, Section 179. If you qualify to use that, you can recover or deduct the cost of certain property in the year placed in service. So, for example, if it was allowed, that $20,000 could be deducted in the first year, the year you put the property in service for your business, which would, of course, reduce the amount of taxable income for that year by that full $20,000. But that deduction is limited to the amount of taxable income from any active trade or business. So you can't create a loss from your business through that Section 179 deduction. And it does not apply to property held for the production of income or use in a not-for-profit activity. The details are provided in that publication 946, How to Depreciate Property. Here on this slide, we're talking about some changes that were made to the depreciation and expensing under what's called the Tax Cuts and Jobs Act, and that's from 2017. And that really, we discussed that primarily here in the last few slides, but there is something also called the bonus depreciation, which would again accelerate the ability to deduct the cost of certain property under that bonus depreciation. So we're giving you this information here to make you aware of it as you're making decisions, as you're talking to your tax professional, that you understand that these opportunities exist under the tax law. There's a form 4562 that you would fill out to identify this depreciation, this bonus depreciation, and there are instructions that go with that to help you, make those calculations. Some other expenses that are associated with small businesses include accountant and attorney fees, tax advice and tax prep fees. We mentioned that we understand a lot of small business owners do rely on tax professionals, and those fees that you pay for the tax advice and the tax preparation are deductible expenses. Also, office supplies, postage, those are other expenses that we see on small business tax returns. Let's talk about supply expense. In most cases, you can deduct the cost of materials and supplies only to the extent that they are consumed and used in your business during the tax year, unless you deducted them in a prior tax year. You can also deduct the cost of books, professional instruments, equipment, if you normally use them within a year. If the usefulness, however, of those items extends substantially beyond the year, you must generally recover their cost through the depreciation that we've been talking about over the previous few slides. Another type of expense that we see small business owners are travel and meal expenses. Businesses can deduct 50% of the cost of business meals if the business owner or an employee of the business is present and the food or beverages are not considered lavish or extravagant. The meals may be provided to a current or potential business customer. Food and beverages that are provided during entertainment events will not be considered entertainment if purchased separately from the event. We also see travel and meal expense, lodging expenses. If you're going out away from your business and tax home. For the travel part of travel and meals, enter your expenses for lodging and transportation connected with overnight travel for business while away from your tax home. The term tax home refers to your main place of business, regardless of where you maintain your family home. Business meal expenses are deductible only if they are directly related to or associated with the active conduct of trade or business. They're not lavish or extravagant, and they are incurred while you or your employee is present at the meal. You do have the option, instead of basing your business meals deduction on the actual cost of your meals while on business travel away from home, you can use another standard deduction that the IRS offers. This is the standard meal allowance for daily meals and incidental expenses. And that's, you can get that information also at irs.gov. Now, just like with the vehicle expenses that we talked about extensively, you need to keep records. It's not enough just to put a number on your tax return for the IRS to accept the numbers. Those numbers need to be backed up by records that show the business purpose of the expense, along with the actual dollar amount of the expense, along time and place. Again, proving the business purpose of the expenses. And that's what we're talking about here on this slide. That meal rate that I just mentioned on the previous slide, you can get information from the U.S. General Service Administration website, and it's called a per diem rate that you can use. Now, additional information about these expenses are provided in those IRS publications noted at the bottom of the screen, publication 463 and 535. So again, the calculation of the net profit or loss that we've been talking about, it's that calculation there on the screen, and we've been looking at that throughout today's presentation on those Schedule C schedules. And there we see it again. Some other possible deductions for you as a small business owner. Health insurance. If you're not covered by an employer's health insurance plan, you may be able to deduct 100% of your health insurance premium on Form 1040, which is here line 17 of Schedule 1 of your Form 1040. This applies to an individual or family health insurance plan. Second, if you're self-employed or a partner, you may be able to take a deduction on Form 1040 for self-employed um, retirement plans that are available to you. They're called SEP plans or a simple plan and other qualified plans. There's an IRS publication, which is publication 560, which will provide details for you. And there are also tax credits that are available to small employers to help them set up retirement plans for employees if you do have employees. So again, wanting to make you aware that this is available for you. Some other deductions that are available for small business owners include the deduction of startup cost. Now, startup costs are the amounts the business paid or incurred for creating an active trade or business or investigating the creation or acquisition of an active trade or business. Startup costs include amounts paid or incurred in connection with an existing activity engaged in for profit and to produce income in anticipation of the activity becoming an active trade or business. Qualifying costs include a startup cost is recoverable, and we're talking there about, in this case, they call it amortization, not depreciation. So a startup cost is recoverable if it meets both the following requirements, meaning you're deducting or amortizing that cost over a period of time. If it's a cost a business could deduct if they paid or incurred it to operate an existing active trade or business in the same field as the one the business entered into, or if it's a cost a business pays or incurs before the day their active trade or business begins. Those are qualifying startup costs that are deductible when you incur them. Let's talk about self-employment and estimated tax. I mentioned at the beginning that self-employed people who are sole proprietors or partners in a partnership may be subject to self-employment tax. Self-employment tax, we're talking about Social Security and Medicare taxes, and you're filing the identification of those taxes on a Schedule SE, Form 1040. There is a resource for you that's available at irs.gov. It's a tax withholding estimator, and it is a site on irs.gov where you go in and you provide information. None of it is identifiable to you, so you're not providing a Social Security number or your name. You're just identifying numbers associated with income and deductions that you expect to have. And that tax withholding estimator will help you calculate the amount of taxes that you should withhold and pay over to the federal government through what we call estimated taxes. And those are paid on a quarterly basis. Again, this is the situation where as an employee, the IRS makes those payments for me. So they're paying over to the Treasury, the federal government, federal income tax, Social Security, and Medicare taxes that are withheld from my pay. But because you're not an employee anymore, as a self-employed individual, you've got to withhold those funds from the earnings that you've received, you've made during the year, and pay them over to the government yourself. And you're doing that again on a quarterly basis through what we call estimated tax. So want to make sure you're aware of that. And we're getting into it a little bit more here on this slide. So again, when self-employed, you may have to pay estimated tax throughout the year. The estimated tax payments are used to make payments against any self-employment tax and income tax. So to be a little bit clear, the slides have been a little bit confusing. I apologize. Self-employment tax, they're referring to the Social Security and Medicare tax. And then also there, they talk about income tax. But on a quarterly basis, you're paying all three of those together through the estimated tax, what we call the estimated tax. Trying to clear that up a little bit. I'm sorry about that. But there's a publication 505, tax withholding and estimated tax, that you can use if you're doing this yourself. If you're wanting to understand it a little more fully, that include worksheets that allow you to calculate the amount of estimated tax that you're paying on a quarterly basis. And you're using that form 1040 ES to make those calculations. The dollar amounts are then you pay to the IRS. And we have a lot of great, easy way to make those payments, all electronically, either through irs.gov or something that we call down at that last bullet point, EFTPS. So I want to make sure everything that I've discussed here today and will discuss over the next few slides, all these resources are free. That includes the electronic federal tax payment system. You have to go to EFTPS.gov, and there you generate an account with EFTPS, but you can make your payments to the IRS through EFTPS.gov. It's all online, and it's a very efficient product to use to get your payments made directly, quickly, efficiently, and safely to IRS. That's EFTPS.gov. Again, on self-employment and estimated tax, each year the combined amount of wages, tips, and net earnings subject to Social Security withholdings change. Wages plus self-employed income, subtract the wages from the maximums to see how much self-employment income is taxable. And that's why you want to use Schedule SE. So again, use Schedule SE when you're doing those estimated tax payments. If you're doing them yourself, if you're using a tax professional to help you with that, of course, they can help guide you through that process. So for more information about self-employment tax, and we're referring there about Social Security and Medicare taxes, IRS.gov has this a site within IRS.gov to help you learn more about it. Self-employment tax, that's Schedule SE, which you're filing with your Form 1040 at the end of the year. So Schedule SE is used at the end of the year when you're filing your tax return for the year to identify the total amount of self-employment tax for the full year. And that Schedule ES that I've been talking about to help you determine the estimated tax that includes self-employment tax during those 4 quarterly payments each year that are made before you file your annual return for the end of the year. Use Schedule ES to determine those amounts, but at the end of the year, to kind of come to the final conclusion, that's Schedule SE is what you're filing with the IRS, and it's just, again, a final return for the year, and you're matching those numbers that you come up with this on self-employment tax Schedule SE with the dollar amounts that you've paid over those 4 quarterly payments, to come up with whether or not at the end of the year you might owe a little more, or you might actually be getting a refund. So estimated taxes, remember those quarterly payments during the year, because your employer, you don't have an employer, you're the employer now. Your employer is no longer withholding. You've got to do that as a self-employed individual. Estimated taxes, more information is provided here at irs.gov. And there's that 1040 ES, which again is helping you calculate those quarterly payments that you're making to the IRS. Those quarterly payments include federal income tax and the Social Security and Medicare tax. And the numbers that you're calculating here in 1040 ES are all based on an annualized what you expect for the year. Just so you understand what's happening, that's what's occurring under the form 1040 ES. I mentioned the electronic federal tax payment system as one way that you can make payment to IRS for the taxes that you owe, the business taxes. Now, just within the last year, we've created on irs.gov a link where you can go in and create a business tax account with IRS. So just like you have an account with, say, Amazon or with your bank, you can create a tax account, a business tax account at irs.gov, where you can go in and see the IRS's record of the returns, the business returns that you've filed for your business, and also the payments that you've made for your business in terms of income tax. If you've got employees, the employment taxes that you've paid during the year, and of course, the taxes that we've been talking about here, the income taxes and the self-employment taxes, the Medicare and the Social Security taxes. You can do that through the business tax account. You can also go in through the business tax account and actually make the payments that we've been referring to. So you've got two options when you want to make payments. You can go in through the business tax account and make the payment, or you can go in through EFTPS and make the payments as well. And there is that EFTPS information. And at irs.gov, you can type in EFTPS, take you to the site, and which will give you a link to go to the actual EFTPS site. I mentioned we've been provided a lot of information today, and we see and we understand that taxes can be complicated, and a lot of people use preparers to help them. We want you to understand that we've got help for you to choose a tax return preparer. I mentioned in yesterday's presentation, it's still true today, unfortunately, there is no federal law that says a tax preparer has to file or has to have a certain amount of education, has to have a certain credential, pass a certain test. Now, some states do have those laws in place, but on a federal level, that does not exist. Anyone can open a tax preparation business. So if you need someone to help prepare your return, we have resources to help you find qualified individuals. IRS.gov, this search term needs someone to prepare your tax return. We want you to understand that even though there's no tax law or there's no law that says individuals have to have certain credentials or have a certain degrees, qualifications, certain individuals have passed tests and do have credentials, and we'll talk about that. There's something called an enrolled agent, and these individuals are licensed by the IRS. They've passed a test given by the IRS. Certified public accountants have passed a test given by their state licensing boards. That includes a section on taxation. both enrolled agents and CPAs have to maintain uh, uh, a they have to go through continuing education on an annual basis. There are certain lawyers who specify their practice in tax law, and they also have continuing education qualifications and credits. There's also something called an annual filing season program, and these individuals have passed a test given by the IRS on an annual basis. Enrolled agents, CPAs, lawyers, they can represent you before the IRS unconditionally. Annual filing season program individuals who've passed that test, they can help you if you ever are needing help before the IRS, say you're under exam, but they would have had to have prepared your return. So just so you're aware, I mentioned we have a website that can help you identify qualified individuals, and it's this directory of federal tax return preparers. At the bottom there, you can type in your zip code and identify a distance from within the zip code that will bring you a list of individuals who are enrolled agents, CPAs, attorneys, have that annual filing season program qualification, who can help you if you're looking for help. We also have other resources on irs.gov to help you individually in your specific business, something called business tax centers, where you can get information specific to specific small business types of small business. There's something called the Small Business Self-Employed Tax Center there in the middle. It is devoted as kind of the one-stop resource for small business owners. For self-employed individuals, there on the next link, the same thing is true. It's supposed to be a one-stop resource for self-employed individuals. There's the Self-Employed Individuals Tax Center, a screenshot of it, the different types of information that you can get. And that include information regarding my self-employed tax obligations. We've talked about estimated taxes, and there's a need for individuals who are self-employed to make sure they understand, again, they are responsible for making sure that their self-employment taxes are withheld and paid on a quarterly basis. Very important. More information how to make quarterly payments available through that self-employed website on irs.gov. So these are the things that we went over today. There's also another publication I don't think we've mentioned yet, and that's publication 334, the Tax Guide for Small Business. That is specific to the Schedule C that we went through here today. Well, I know we went through a lot of information, and I really appreciate you hanging in there through all this. So that's the end of the presentation I have for today. And I, again, appreciate you staying with us and the opportunity to make the presentation today. And I'm going to give it back over to Blanco.
Thank you so much, Mike. This was amazing. There are a few questions in the chat. Let me see. So Kimberly asks, she has a parent company as well as 2 subsidiaries. So each one, all single member LLCs. She's asking if she can complete the Schedule C in totality for both subsidiaries and file under just the holding company.
I believe the answer is yes, but I'd be more comfortable if I could research that for you and send you information based upon my research. Could I do that?
Yes, thank you. Absolutely. Thank you.
If you could send me an email, I'll be happy to respond.
Okay, there's the email, Kimberly, if you want to reach out to him directly. And for everyone's information, yes, we will have the webinars here recorded and uploaded to our website once the 8 sessions are over for the future use of our clients. So don't worry about that. Cynthia says, so the self-employment and estimated tax does not apply to an LLC or a C Corp?
Well, it depends. What it's referring to is those situations where those taxes are not being withheld during the year by an employer. I gave the example of me as an IRS employee where my employer is making those payments. If those payments are not being made, you've got to make those withholdings and make those payments on a quarterly basis.
Okay. And there are no other questions. I wanted to ask you a question that I had from one of my clients. She was asking if she has a digital service company and she has subscriptions for photographs that she uses for her services. So she was asking me if she can consider those as cost of goods sold, but I didn't know what to answer because it's not a good that she's selling. It's a digital subscription and then she sells the service, right? So how would that be considered?
That would, to me, just be a line item expense. It's deductible. It's part of what you're doing in your business. It's an expense of the business. It would be one of those line items that we talked about.
Okay, thank you. Okay, so does anybody have any questions that are not in the chat? Or I know we're right at the 1 o'clock hour, but if you can stay and maybe ask a few questions if you need to, please do. I think everybody's stunned with all the information.
I am too.
I know. We all need time to digest the forms.
Very much so.
Great to know that help that is available. I don't believe that people know that that resource is available. The tax preparers, and that is great to hear.
Yeah, I think maybe the more just as important to the information is identifying the resources that are available, because there's a lot of great information for you 24 hours a day, 7 days a week at irs.gov.
And that is for personal taxes too, or just for business taxes?
For everything,
For
yes.
everything. That is amazing. Okay. Luis, will you have a session on determining if you need to file state taxes in a state where you are not located and not only sell services online?
Unfortunately, I'm only going to be talking about federal taxation, IRS. I would go to your state Department of Revenue to get more information.
Right. Yes, and the online e-commerce has a different angle to it, right? People selling online and they're tax liable in different states. Once you reach a certain point, is what I know. Once you reach a certain point, you are tax liable into that state, but yeah.
Yeah, that's state specific. So unfortunately, I'm only knowledgeable in the federal taxation that we went over here today. I would want to comment on anything associated with the state. I just don't have that knowledge.
Okay. Someone is asking, will you be covering S Corp? I believe you did at the beginning. I mean, this applies to S Corps. This is a form, the C form is the Schedule C is for everyone, right?
Yeah, unfortunately, in these 8 lessons, we don't get in depth on S corporations. We do have some presentations and information that I can send to you if you'd like to send me an email, and I can point you to the resources that we do have. And if you specifically identify in your email what exactly you're looking for, I will do everything I can to provide you with those resources that you can go look up and look into yourself.
Okay, great. She's, okay, thank you. All right. Well, I believe there's not a lot of, questions at this point, Mike. I'm, presuming that some folks might be reaching out to you directly with specific questions. And we want to thank you again for doing this. This is amazing information for our business owners. So thank you, and we will see you in the next webinar.
Thank you very much.
And thank you everyone for coming in today.
Have a good day.
Bye.
Bye.